So if you've, had life happen to you and you're 50 or over and you haven't started saving for retirement yet, don't panic. And I'm not a financial planner. I have no certifications. I just have School of Hard Knocks. So I'm going to talk to you about what you could do. If you invested $200 a month in something that was similar to the S&P 500. The S&P 500 has historically returned about 10% a year. By the time that you would retire at 67, you would have $71,000 in the account. Not bad for $200. The reason is because of compounding interest. So compounding interest is just, let's say that you have $1,000 invested in the market. It earns 10% a year. Well, now you've got $1,000 times 10%, which is going to be $100. Now that $100 gets added into the $1,000, and now you have $1,111 times 10%, which is going to earn you $110. That gets added in. So now you have $1,210 times 10%. That's if you just let the money sit there. That's if you just invested the 1,000 and didn't add anything else to it. That's how much money the money is making you. Because the money that you earn, the interest that you earn, gets added to your principal, and then the new money that you earn, your compound interest, gets added to your principal, and this just keeps repeating over and over and over again. So you can see, putting $200 a month into an account, you would be able to then grow that money to possibly $71,000 depending on the market. It might be less, it might be about $58,000. It just depends on what the market's returning and what you're invested in. But if you went with something that was close to like the S&P 500, it typically returns about 10%. Now, if you're wondering like, okay, that's great, but how do I start investing? So a lot of times people think that they need to start investing like, buy, sell. You don't have to do that. And we're not talking about day trading or anything else that's similar to gambling. What we're talking about is being consistent over time, because that's what matters when it comes to investing and keeping your money safe. So there are a couple different companies that you could go with. I will put links into the first comment to them. There are a couple different companies that are well known in the industry that people go with to handle their investments. You have Fidelity, Schwab, and Vanguard. Each of these companies has something similar called a robo-investor. And it's going to ask you a series of questions like, what's your risk tolerance? How much are you willing to spend? What will you be putting in? It asks you all these questions. When do you want to retire by? There's like tons of questions that it asks you, and it helps you figure out how you want to invest your money. Now, when you do this, understand that you need to go with a house that's well known. Don't go with somebody who you don't know, who's not a big house. You have to be really careful and make sure you do your due diligence, that they have a fiduciary responsibility to you. That means that they're not in it to make money from selling you different things. So fiduciary responsibility is really, really important when it comes to investing your money and keeping it safe. The other thing is don't do something that you're not comfortable with. If you're not comfortable investing your money in a certain way, then don't do it. You need to do your due diligence and your research to make sure that the investments are investments that you're okay with and that you're comfortable with. Don't let anybody push you into one direction or another, and that includes your risk tolerance. I, in the past, have been pushed to be like more risky, and I'm like, I don't want to be more risky. I'm perfectly happy where I am. Back off.